From cornfields to high-rises, office to industrial, houses to hotels, and every other asset class in real estate, we cover the people, the projects, and the profit. Welcome to the Investing in Iowa show. This show is for go-doers, action takers, and business owners. It's for people like you who are sick of Uncle Sam taking a huge bite of your apple. If you're looking to get ahead of what's taking place in Iowa, learn who is doing what, and how you can get in on the action, you're in the right place. Hosted by Neil Timmins, an Iowa native who has been involved in over $300 million in real estate right here in Iowa. Recording in studio from West Des Moines, here's your host, Neil Timmins.
I've got Ryan Cahalan here on the show. Ryan, welcome.
Thank you for having me, Neil. Good to see you again.
Good to see you.
It's been too long.
It has been a long time. Say, for the audience to say, who are you? Where are you from? What do you do?
Sure. My name's Ryan Cahalan. I'm from Mason City, Iowa, about an hour and a half north of here, born and bred, Newman Catholic grad. Went to University of Northern Iowa before starting my career in real estate. So,
you started your career in real estate where and what were you doing?
Great question. UNI actually has a fantastic real estate program, which I'm sure you're aware of. So I was lucky to benefit from that. Actually did an internship with Aegon USA in Cedar Rapids, which was a great way to get my foot in the door of commercial real estate and start to put the big picture together on what all commercial real estate entails, from the various asset types, from office, industrial, retail, hospitality, apartments, and then also how those deals are capitalized from a debt and equity standpoint. So that kind of put the big picture together. By virtue of that internship, I had the opportunity to join, after I graduated, Holiday Fenoglio Fowler, HFF, which is a large real estate investment bank, if you will. And they offered me the opportunity to move to California. So 22 years old in 2000, I moved out west for 2 years and cut my teeth with the big boys and continued to learn, right, on kind of how the different, asset classes work and how to underwrite those deals and how do you make any money on them. Decided I wanted to move back to the Midwest, which was probably a theme we'll get to here later on. But I'm a Midwestern guy, wanted to be in the Midwest, picked up my MBA at the University of Wisconsin in late 2002, and landed in Chicago early 2003. So I've been Chicago-based for 21 years now, but I still consider Iowa home. I'm an Iowan, born and bred, and when people ask me where I'm from, I say I'm from Iowa and live in Chicago. So
you landed in Chicago in 2003.
Yeah.
And what did you do? What was that like?
Great question. I started as a lender, kind of going back to what I'd known from the Aegon experience and the internship, and felt it was probably very good in my career to get a strong skill set as it relates to the financing and understand how to underwrite. Had a great opportunity to go work for PPM America, originated mortgages for commercial product across the country. So I was on the airplane quite a lot, but it was great to get to know Phoenix, Florida, California, these other markets I hadn't spent much time in. So, but I quickly got bored of being on that side of the table, the lender side. Every transaction you're dealing with a principal who's borrowing capital, putting that capital to work in the hopes of making money. Right. And as a lender, you're capped on how much you can make, right? You get your loan back, your principal back, and some interest. So I wanted to, be a little bit more entrepreneurial and risk-taking, wanted to be on the other side of the table. Had the opportunity to go work for a large private equity firm, Walton Street Capital. Actually worked for the operating company that was buying apartments that was backed by Walton Street Capital. So Walton is a very big equity source, and it enabled me as a young person in my career from 2004 to 2012 to cut my teeth, putting deals together with someone else's capital, so to speak. It was a dedicated source of equity. So from 2004 to 2012, I was on an airplane every other week. Again, traveling across the country, first underwriting markets before even looking at a stick of real estate. What makes a good investment market, right? What are the fundamentals about that market? And then ultimately, okay, within that market, where are the sub-markets you want to be? Every city, in my opinion, or metro has where you would like to invest and buy, and where areas you need to understand the fundamentals and maybe steer clear of some areas. And then you get into the real estate, right? And start kicking the tires on real estate and buying that. So I'm very fortunate. I call it kind of my PhD in real estate, that 8-year run to acquire assets with this private equity source.
You saw a tremendous run up and then a run down.
I say I had a front row seat to a very full and dramatic real estate cycle. I mean, no doubt about it. 2004 to end of 2007. this is when underwriting fundamentals were compromised. Lenders were making loans they shouldn't have made. Right. But there was a lot of capital that wanted exposure to real estate, right? And people thought trees were going to grow in the sky, and you effectively lied to your calculator. You made some very wildly aggressive assumptions in your model, yep. And then assumed that at the back end you were going to sell it for a price that, in hindsight, it's easy to see this, but at the time there was so much capital flow in the market that you had to be really aggressive. And then obviously, September of 2008, the world changed. Actually, there were some hiccups earlier in 2008, but in September 2008, things changed dramatically. And I count myself as very fortunate because I didn't lose my job. There's a lot of guys out there, right. But guys and gals in the industry that, were downsized, unemployed. Wall Street wanted to keep their deal guys hungry and want to know where the opportunities were. And they didn't know when, but they felt they were going to flip the switch at some point and want to pounce and know where all the deals are, so to speak. So, it was a lean couple of years. It was kind of scary, but I was fortunate that I had a job. And then when they wanted to start investing again, we went big. We bought deals in Dallas and Nashville and DC and had a good run. But the downturn also was very fortunate to me in another way. I personally started buying 2 and 3 unit buildings in Chicago in the neighborhood I had lived in for years. North Side neighborhoods by Wrigley Field, Lincoln Park, Lakeview, Bucktown, Wicker Park. And I call it my side hustle. I was out, talking to banks and had a couple banks that when anything would come back in a foreclosure, I would, have a look at it and end up buying. I need to get the exact unit count. I think I bought some 30 properties from 2009 to 2013 or 14, originally with my own capital. Whatever nickels I had, I'd put down, and then ultimately started raising what people call friends and family capital. Right, I'd see a good opportunity. And these were buildings that I knew what they'd rent for. 2-bedroom walk up in Chicago. I felt pretty good where it'd rent for. Knew what my expenses were. I was doing all the work myself. So I thought I was downside protected in those deals. And ultimately the market came back and was able to, benefit some appreciation. And but that's where it gave me the itch to maybe kind of go do something by myself, kind of that entrepreneurial fire, see an investment, have an idea, develop a strategy, and go execute. And a lot of people maybe have the idea and don't get around to doing the strategy or let alone execution. Yeah. But it's actually doing it is what, is kind of scary, right? Because I left my job at the end of 2012. And that first Monday, I woke up without a paycheck coming in. You're uber motivated to go make something happen.
So I always said nothing makes you more motivated than knowing you might not eat tomorrow.
That's right. That's exactly right. So no, the downturn of that time was very interesting for a couple of reasons. I use it to my benefit, but I also was fortunate that I was with a shop that kept me employed. So
it sounds to me, I know a lot of people from that era. A lot of us are around that era, but a number of us weren't wise enough to know the opportunity that was in front of us. You clearly identified that at a young age, right? A bunch of people, a couple generations or a generation ahead of us were wise enough. They had seen enough cycles.
Yeah.
But you were there and you identified that. What gave you that comfort level to believe that this was a tremendous opportunity?
Well, a couple things. Generically speaking, to use a blackjack analogy, I felt that the dealer was showing a 6 and I had 20, right? So that's when you put money on the table. Your odds are very good.
Well,
said separately or differently, and now there's a term in the industry that I hear all the time called asymmetric return. Downside protected, but the potential for a really big upside. And looking at how I was underwriting these deals in Lincoln Park that I knew very well, that I knew I could keep occupied, I felt the income that I was buying was very durable. And at that income, I was making money. So my base underwrite was, I'll assume I'll never sell this. I'm just going to clip a coupon. Now, there's capital that comes at you. I mean, real estate's not a passive investment, and it's not as easy as just, your rents are this, expenses, that's going to be your yield. You replace a roof or a furnace or whatever, that's going to impact. But I felt I was downside protected from a value standpoint because I wasn't really worried about value because I had income and I was going to pay my mortgage and sleep well. But I knew at some point what goes up must come down. I thought it was going to take, it could have taken a decade, 7, 8, 9, 10 years. The market came back in 3 or 4 years to a point where I was able to sell and make, a nice multiple, right? Not only double my money, in some cases, it was 3 or 4x.
Yeah. Incredible. And then what'd you do with the money? You parlay that into something else?
Ultimately, yeah. I mean, it's a little bit of a growth ladder, right? But I think a fundamental shift happened in 2013 into 14 when I took a step back, and this is maybe where a nice dovetail to Iowa. I took a step back. I saw these assets in Chicago, the small cap deals, were starting to get more pricey, and I wasn't able to underwrite to those returns. That made me feel good that I was downside protected.
Yes.
So I took a step back and analyzed capital flows nationally for apartments, right? And coming out of the downturn, in any downturn, I don't care what it is, there's a flight to quality.
Correct.
And in multifamily, the flight was towards the growth states in the South and the coast, right? That's where population centers are growing. There's a lot of reasons, right, that these are durable markets. But the Midwest was viewed as, sleepy flyover region, right? And not just a state, a region. And I felt there was an arbitrage there. I felt that the Midwest was being mispriced in terms of valuations, in that it was selling cheaper than it should have sold based on a variety of variables. While you're not, in general, going to get huge rent growth years in the Midwest, it's slow and steady. And a data point I always like to point out, like in 2010, coming out of the downturn, when the U.S. unemployment was 10%, Des Moines was like 5.8 or 6, right? So like it's a good hedge in the downtimes, and it keeps up nicely with the growth phases.
Right.
So I just felt there was an opportunity to buy multifamily assets in the Midwest at below prices that they should be selling at. It was a very generic and general way to put that. Said differently, I felt it was trading inefficiently. You can buy directly. Oftentimes, you can buy through maybe a broken marketed process, as opposed to these large markets. There's going to be an investment sale professional on them. They're going to blast it to 1,000 potential buyers. Right. They're going to give 50 bids, and then they're going to create a little auction. That wasn't happening in 2014. So I really kind of put a plan together and set out to start buying larger multifamily assets in Des Moines because I felt it was a good investment. But it was because I also love Iowa, and I wanted to be here. I wanted to grow a business here.
Hi, it's Ava Baukamp, the Investment Relations Manager for Neil's firm, Legacy Impact Investors. I'm inviting you to join us for our next investor workshop, our monthly Legacy briefings. In these tactical Zoom calls, we cover topics and case studies for subjects such as taxes and depreciation, navigating macroeconomic shifts, and evaluating deals as a passive investor. At each virtual workshop, we are joined by an industry guest who covers their topic in 45 minutes or less. No fluff, no pitches, just education and conversation with an expert each month. Every workshop ends with live Q&A from Neil and our guest. All briefings happen on the last Tuesday of the month at 3 p.m. Central. If you can't make it live, recordings are sent out exclusively to those who've registered in advance. To join us on the last Tuesday of this month, visit legacybriefing.com. Go to legacybriefing.com to register. If you're a first-time registrant, I'll send you a free resource at sign up. Head to legacybriefing.com, and I'll see you soon.
2013 was the first purchase here in Iowa?
I bought a 14-unit deal in Sherman Hill in 2015. In fact, I just recapped with my team about this yesterday. So I probably overpaid, right? Because I didn't know the local dynamics, but I thought it was a good deal. In 2016, I jokingly say I caught the tiger by the tail. I was able to buy a 261-unit deal in West Des Moines with a capital partner that I'd met on doing some of my small cap deals in Chicago. And that really kind of put us in business. In 2017, bought 3 more deals, one in Johnston, one downtown Des Moines, and one Cedar Rapids. And that brought me to 922 units as a sole GP. I realized it's time to be real. It's time to put a team together, get business cards, build a company. And that's when I formed Artisan Capital Group with my co-founder partner, Mike Perry, who was a colleague of mine at the private equity firm I mentioned earlier. So Mike and I were a kind of two-headed monster, 2 men in a truck, trying to execute a multifamily strategy. And then sure enough, the first 12 months of our company, we didn't buy a single asset. We were bridesmaid. We swung and missed at so many different things. And honestly, at the end of 2008, or going into the fourth quarter of 2018, we weren't sure we were going to be solvent or around much longer. But some deals came our way. We ended up buying our next 900 units that we bought was 13 different transactions. So my first 900 units 4 deals. The next one, so we got scrappy, we got gritty.
Right.
We put the portfolio together, and we were able to get over the hump. And I guess to fast forward today, we're now 7,400 units, $1 billion AUM. We've become the largest apartment owner in the state of Iowa. It's been good. It's been a good run, and that's all because we've been able to put together a great team to execute the business.
I remember. I'm trying to go back to the year you and I would have met, but I remember
those years, 15, 16, maybe
somewhere in that, mid to late teens era, and And I remember having this conversation about the inefficiencies in the marketplace and your experience in Chicago and why here and what you were looking to execute. And I just remember all the work you were doing to get in front of an owner, to be able to, and the brokers to be able to put deals together.
Yeah, I think you got to qualify yourself as a buyer, that you know what you're doing, you have familiarity with the asset class, but you got to form those relationships, right? I mean, you can't parachute into a market from the coast or whatever and spend come here once a quarter and develop those relationships. I mean, that's when you have to be local. I don't know how many times I've driven from Chicago to Des Moines, but it's a lot, right? I mean, it was weekly, and I still come back. So you got to be local. You got to develop those relationships to find the opportunities.
Yeah, it's more specifically, you have to do it here because you could go into I suspect you could go into LA and you could participate there if you're willing to pay up, because they're going to distribute the information to a plethora of people. They're going to go through a formal bidding process, as you said, a mini auction. If you throw your hat in the ring, you pay up, you can be there.
Yeah, you can buy everything. Anything, you pay the highest price. Yeah. But we've got a fiduciary responsibility for our investors to make prudent investment decisions and ultimately return capital.
Yeah, but even to this day, because of the relationships you formed, I suspect sooner or later an opportunity gets put in your lap with a price on it, and it's an opportunity put in front of you, not in front of 1,000 people, and it's going to go, we know you can close because you've proven it time and time again.
You're absolutely right. That's a great point. I mean, you do your due diligence, things happen, and you learn a lot, but people know that we are qualified buyers. We're going to do what we say we're going to do, and we've got the credibility to close. So we've got the capital relationships to close. So we get a lot of looks from owners say, hey, we want to sell. We don't want to screw around. We don't want to work with a group that's going to tie this up and then come retrade us at the end. We want a diligent group that's going to run a good process, do their homework, and then close it. And it's a testament to the team we've been able to put together at Artisan that really has this all hands on deck approach to execute business. That I think has given us that reputation that we're gonna close.
Let's talk about the team. You've got a property management team who you self-manage almost all at this point.
About 2/3 or maybe 3/4 of what we own, we self-manage at this point. But so Artisan Capital Group, I call the investment side of the business, the investment company. We're up to 14 people, and kind of the division of responsibilities goes from kind of the acquisition efforts, asset management. We take the oversight of our investments very seriously.
Yes.
I mean, executing the business plan is crucial to optimizing your return. So acquisition, asset management, construction oversight. We have in-house construction oversight, which is very critical. Investor relations, we have in-house counsel, we have a head of accounting. So we've really kind of built out the full suite. We want to be the best multifamily owner-operator in the Midwest and have a very institutional approach, right? I mean, if we're soliciting capital from large equity sources, we need to have all that buttoned up. Originally, we started, because we were lean and mean, using third-party management companies. And there's a lot of good third-party management companies out there, but ultimately you give up an element of control in the day-to-day operations. And again, we felt that to optimize the return, we needed our hand on the wheel there. We needed to execute that. And it took a lot of work, right? Our headcount went up significantly, but in 2019, we started our own management company, and then selectively would kind of transition our management company to the assets we already own. And then going forward, we would self-manage anything going forward. So of our 7,400 units, I think we managed 5,200 units. We're also active student housing buyers, and student housing is a different animal.
Totally.
And we likely will not self-manage student housing. We'd rather work with the best operator management company in those markets, just given it's a nuanced kind of specialty. So, but on our rate side, we're going to continue to self-manage. And that's when our headcount really skyrocketed. as of last night, we had a company event. I believe there's 130 plus people in the room between Artisan Capital Group and Artisan Management. So it's been a great growth trajectory. If you would have told me 7 years ago when we started this that we'd have this headcount, I'd tell you you're crazy. But it's been good. And what gives me the most satisfaction, I jokingly say we're not a real estate company anymore. We're a people company, just given all the resources that go into it. And we provide not only housing, we provide homes for more than 12,000 people, right? And we take that very seriously. So it's all about the people. So that gives me the most satisfaction of putting this team together, being involved in this team, and what we're.
As a result of having property management in-house since 2019, what have you learned that you wish you knew prior to having the property management company, therefore would have impacted the asset management rules on your team and what you would have put the other property managers through?
Yeah, I think, looking at an investment on a computer spreadsheet, it's just numbers, right?
Yeah.
And behind those numbers, whether it's a real estate tax, insurance, payroll, there's a lot that goes into it. And, understanding the full magnitude of the type of team that you need and the support that you need to give to your on-site people didn't register, before starting the management company. But it's important, right? I mean, we want to be very responsive, owners. We want to provide people a clean, safe place to live. And that doesn't happen by snapping your fingers or, wishing it will happen. You've got to go make it happen. So that human element of really overseeing these properties and then getting the right team on the field. And, we're in a market where hiring and retaining good staff is very challenging. So we want to try, we're creating this from the ground up. So we have the opportunity to put our own kind of fingerprint on it. And I underestimated that as well. The idea or concept of when you have a company this big, creating that culture that people buy into, want to be, coming to work every day, happy at work, satisfied by their job. And there's a lot that goes into it. We're still looking for the secret sauce, but it's a concept that I hadn't thought about before starting the management.
It was 2014, you bought your first 14 unit in Sherman.
2015.
Yep. Thank you. And then 2017, you're up to 922 units.
Correct.
How had you had to change from 2017, 922 units, to 2024, over 7,400 units? How are you as an individual?
Well, one, God bless my wife for putting up with my schedule. I'm still searching for balance, right? I'm spending a lot of time, my colleagues and I spend a lot of time in this, so, working for balance. So I'm looking for that change, right, to actually find that balance. But I think as you scale up, you need to you want to be entrepreneurial, but you need to start implementing some administrative controls and devices, processes, procedure, right? So that's one change. I mean, when we started, it was the wild, wild west, right? We felt we were making good investments, but the oversight and the execution was kind of, shooting from the hip a little bit. Now we can't afford to do that anymore. We have to have things buttoned down. So that administrative transition has happened, and a necessary transition to happen. And I have the ability too, having this great team around me, that I can think a little bit more strategically and not be in the weeds on a day-to-day standpoint from like a due diligence of a new acquisition. I can focus on strategic relationships with investors, lenders, my colleagues in the industry. That doesn't mean I'm not involved on the day-to-day or can kind of drill down when needed, but I can fly at 30 or 40,000 feet a little bit more now than I used to, because back in the day, it was just me.
If you're a house flipper, execute the burst strategy, or do double closings and are in need of money, Little Guy Loans is your go-to lender here in the Des Moines area. Time is money. Loan approvals in 24 hours. Closings in 5 days. Little Guy Loans was founded by Neil Timmins, an investor just like you. Since he has been in over 10,000 homes in Des Moines, there's never an appraisal. Houses, multifamily, and commercial property loans up to $1 million. Check out www.littleguyloans.com.
It's interesting that you have to go through. It sounds to me like you've evolved, some of that early stuff is an investor. It's executing. It's wearing all the hats ultimately to where today you've built a business.
Yeah, that's absolutely right. I mean, you're doing everything from soup to nuts, when you start. And now we can put people in their lane, right, and kind of build the machine so people are specialized in certain functional areas and they are experts at that area. So it's again, I never thought we'd get this big, but it's been nice to find people, and it's great to see people really have a passion about what they're doing, whether that's marketing or construction management or asset management. I mean, people, you gravitate to different parts of the business, and we've been able to assemble a team that in their specific line of work, they're best in class.
What's the exit for you? And I'll put a little more color to it.
Yeah.
Des Moines continues to grow, fastest growing city in the Midwest.
Yes, I tell that to investors on a daily basis,
and they got to. I bet they fact check you because at a gut level, if they're not from here,
sure.
It doesn't. You're like, really?
Yeah.
But it's true. Sooner or later, we're going to move out of a tertiary market into a secondary market.
Yep.
I suspect cap rates compress. So I'm wondering, as you look forward for the portfolio, I'm wondering, those are the kind of drivers for you, or is it? What do you give thought to?
No, that great question. And to your point, our original thesis effectively proven out. What you just said has already happened, right? Like, we're not secondary. Des Moines is not secondary yet, but it's pretty close. And there's a lot of eyeballs on Des Moines now.
Yeah.
The dynamic I described, the inefficiency is no longer there.
Right.
In scale, there's a lot of coastal capital that loves to invest in the Midwest because it's slow and steady. It's not this. Right. So really 2021, cap rates dove by 1.5. I mean, we were buying high 6 caps, and all of a sudden it was mid 5 caps. Yeah. So that's already kind of happened. But to your point earlier, we feel we're qualified, credible buyers that can get things done, and we're actively buying in Iowa. We're going to continue to scale here. We've grown into Omaha. We have 1,000 units between Kansas City and Lawrence. We're working on something in St. Louis right now. So really, from a business strategy standpoint, we think Chicago is kind of a contrarian play right now for the reasons I just mentioned about why we liked Iowa in 2015, 2016. Chicago has a different story, but it's kind of a contrarian play. And we view Chicago as the third largest city in the United States. Yep. If I can buy Chicago cap rates 100 basis point wide of Des Moines cap rates, right, now it's time to maybe start looking at Chicago.
No doubt. Yes. I mean, you've had an exodus of people over a period of time.
Yep.
And does it cycle back at some point, as so many cities have proven? Yes, it all comes around.
Yeah. The city, there's been an exodus from the city. The suburbs are still very strong. I mean, a lot of the suburbs are strong. But again, you get into the groupthink mentality of a lot of the capital flows, as I mentioned earlier, and there's so many people that are just, nope, not buying Chicago. Right? What I read in the headlines, they're not really willing to actually look at numbers on a piece of paper and say, wow, this is a phenomenal risk-adjusted return. Right? And that term risk-adjusted gets way overused. But for me, it's like, okay, how can I build into that that situation I mentioned where your downside is relatively protected and there's asymmetrical upside? And we think Chicago is the opportunity there. So, we're not, who knows? I'm never going to say, I'm never going to put a ceiling on what we can become. I think we'll get to 10,000 units if we continue to find good deals to buy. And then, we'll see what evolves. I mean, we're not going to force anything. We're not going to buy deals for the sake of buying deals because you get in trouble that way. Right. But at 10,000 units, I think we have a very sizable enterprise that allows us to buy a few deals a year, sell a few deals a year, maintain a very strong infrastructure, and see where the opportunities take us. I mean, I've always said we're not afraid to pivot. We're gonna find where we think there's an edge in an investment strategy, and exploit that edge until the crowd catches up with you, and then go find the next edge.
What are you most excited about this year?
My wife and I are going to Spain next week, so I'm excited for 2 weeks in Portugal and Spain. But we've really worked hard over the last, really since starting the management company, of getting the right team on the field and the right butts in seats, if you will. And I feel like we're coming into our own. I feel like we're there. So I'm looking forward to kind of stabilizing operations, and that's at the corporate level. And by doing that, the properties, I think, will continue to perform very well and optimize. So I'm looking forward to that balance I talked about. It's been a long 7 years, but anybody who's an entrepreneur knows that you got to lean in and make it happen. So and leveraging the team that we've put together, right, to let them do their jobs, and I'll do my job, and just some stability. I mean, we've been in a growth mode for 7 years.
Yeah.
And now I feel like we're plateauing to a point where like, okay, we're running on all cylinders and we're in a good spot.
Final 3 questions. You ready?
Okay. Yeah.
If you had one piece of advice to your 20-year-old self, what would it be?
That's a good question. Give me a second on that one. Well, ultimately I got there, but I'd say do it, right? Don't just think about it. Don't just kind of strategize about it, but do that third thing. And I did end up doing it, right? Like I launched this thing in 2014, 15, 16, whatever it really was. I kind of thought about doing it earlier. So just to reaffirm to my young self that, don't be afraid to take a risk. There's no guarantee of success, but you can navigate a failure if you try something. The worst thing is getting down the road saying, crap, I should have, right? So that I think is an important lesson that I ultimately got to in my 30s, but maybe should have done it.
2 books that changed your life.
Well, I got to say the Bible, right? I like a lot of Malcolm Gladwell stuff, the way he thinks, tipping point, thinking outside the box, I think is important and getting perspective. Freakonomics was interesting when you talk about all of these other kind of socioeconomic issues and how that impacts economics, and seeing that, some things are correlated, right? And like this is happening, that, what are some potential outcomes of that? It could be this,
right.
It could be this. So, I also like to read for fun. I mean, it's kind of the way I relax my brain and read novels. I don't know, I probably read 12 books already this year that are mostly novels, and nothing's coming to my mind right now. So my wife's going to kill me because I didn't give you a great answer on that, but I'll get back to you.
That's good. All right, the question I'm most excited about to ask you. If you were cast away on an island for a year, you could only get 3 pieces of data about your business each and every month. What 3 things must you know every month to know how your business is running?
Well, I need a trailing 12 for each property. Is that?
I'll give it to you.
Give me a rolled up T12 so I know how we're looking. Yep. I need a occupancy report, which would, in theory, dovetail to the T12.
Yep.
And I need correspondence with my investors. So that, usually that originates from us, but I would need some sort of communication with our investors to know that, they're satisfied, they're happy, and that we're in good shape.
Right. I've asked you tons of questions. I know we could talk for days on end. What's one question that I did not ask that I should have asked?
I don't think you specifically asked why Iowa, and I think I gave the answer there. Maybe why multifamily?
Oh, terrific question. You're right.
As I said earlier, in my career, I underwrote a lot of asset classes: office, industrial, retail, hospitality. I even underwrote golf courses, and ultimately I gravitated towards multifamily as an asset class because, and this is going to be a little philosophical, but I think one's environment where they live has so many different impacts on their life.
Sure.
Right. And you're going back to what I said about clean, safe place to live with responsive ownership. I whether that's a C property that costs $500 a month or it's a luxury A property that's $5,000 a month, I think people desire the same things. And again, a little philosophical because I'm a for-profit business. I want to make money. But for me to be able to merge those 2 things in a business in a career have been satisfying.
That's terrific. Ryan, I appreciate you taking the time to connect. For people, they want to find you, they want to follow you, they want to connect with you. Where can they go?
Find me on my website, artisancapitalgroup.com, artisancapitalgroup.com. We'll have my bio, my contact information's on there. And would love to continue to network.
I appreciate it.
Thanks, Neil. Appreciate it.
Thanks for listening. If you're enjoying the show, may I ask a favor of you? Naturally, subscribe so you never miss an episode. But would you rate and leave an honest written review on Apple Podcasts? It does a lot for us here at the show, and I appreciate reading your thoughts. Great guests make for a great show. If you know of another Iowan who would be a great guest, or you yourself have interest in being a guest, well, get on our radar. Visit Investing in Iowa to fill out an application or recommend a guest. And if you want to connect with me one-on-one, go to legacyimpactinvestors.com. iowainvestorworkshop.com. Click on the Invest With Us button in the top right corner, and there you can pick a time for the two of us to get on the calendar and connect. Until next time, keep investing in Iowa.